Good afternoon, everyone. Thanks for joining me today. Today we're going to do a market update, but my portion of the market update is really going to focus on the international markets. Matt spoke more so about domestic markets, but U.S. is only one economy of many in the global economic environment, and many of those international economies are very important. So Europe, if we want to go back to last year, a lot of people were talking about how things were just going to get really bad in Europe. The energy crisis, gas prices were soaring. Those type of energy prices would really make it difficult for consumers to discretionary spend. Too much of their budget would go toward utility bills. And so the outlook looked pretty bleak. Industrial companies as well, high energy bills make them uncompetitive versus international companies that have lower energy prices. So there's a really bear market story that was starting to develop in Europe. But Europe's been resilient. What I'm showing you here is that purple line, if you can see it, the line at the top is Europe. This is the Citigroup Economic Surprise Index. And this is really what it tells you is what the economists are forecasting versus what actually occurs. And so when economic numbers come in a little bit better than forecast, this index goes higher. And what's happened over the past 6 months is we've seen in Europe the actual economic conditions have continually been a little better than forecast. The best in the world, actually, the surprise index. They have outperformed projections better than any region in the world. And so that has led to some outperformance in Europe. Part of that is what I'm showing you here, and it's really just the lines. If you can't read the numbers, it's not too big a deal. It's the trend that matters. The natural gas EU Dutch futures, you can see right now they're actually lower than they were before the war, before they had their gas shut off by Russia. And they've had some fortuitous developments. It's been a warm winter, so that has helped a lot, but slowly and steadily, the European Union has really been working on getting away from Russian gas. There's LNG plants and infrastructure going up out northern coast of Germany. A lot of things have been put in place. And, when that was such a shock with Russia turning off the gas supply that you can't fix that overnight. And so you saw that spike in the summer months, particularly, looked really bad in September. But they're making progress, and they're going to continue to make progress, and they will not be able to fully replace the Russian gas soon, but they're going to get close. And when you have warm weather like they did in the winter, then it creates surplus storage, and that's why we've seen gas prices come down a lot in Europe. And it's important. It allows their companies to be more competitive, the industrial companies, and it gives consumers some extra spending money. Another note on Europe, Europe in America has this sort of, some people think of them as sort of lazy, don't like to work. Certainly the Southern European nations have been classified as such before. That's not really the case. Things have changed. What I'm showing you here, this is labor force participation. Some of the European economies have labor force participation at the highest it's been in years, maybe even ever. And labor force participation may not be defined exactly the same in the EU as it is in the US, but what matters is a trend. And you can see on this graph on the left, the past 10 years, a steadily rising labor force participation rate. They're working. They're getting out there and working, regardless of what Americans' view of the Europeans is. Meanwhile, on the right, you can see that the US has had pretty much a flat labor force participation pre-COVID, and then we saw the huge drop in COVID, and it's been slowly working its way back up. but we are nowhere near where we were. Oh, we're getting close, but we're still not at where we were pre-COVID. Our labor force participation has actually been a somewhat of a sad story the past few years, and you see the steady improvement in the EU. Why does labor force participation matter? Well, labor force participation matters because it generates income that people can then spend and create that virtuous cycle of growing an economy. The other thing it really matters with, which is important these days, is inflation. More people in the labor force creates maybe perhaps some spare capacity in the labor force. Spare capacity in the labor force is a good thing for keeping prices down. So, this is something I'm paying attention to a little bit. The labor force participation rate in the U.S., in my opinion, needs to pick back up, or we're going to have some challenges really growing our economy in a productive way. The red line here is the S&P 500. The blue and orange lines are the stock 600 and the topics. Topics is the Japanese stock market. U.S. stock prices have always traded at a premium to Europe and Japan, or at least, in recent times have traded at a premium. Sometimes that premium really opens up in a big way. Sometimes it's a modest premium. You can see that, premium post-COVID, which is sort of after that surge. And what this is showing you, I should go back and say, this is the price to earnings multiple. You can't see it, but the red line is the price to earnings multiple of the S&P 500. Blue and orange is topics, and the stock 600, which is Europe. That red line had a pretty big gap. When that red line is above the European and Japanese ones, that shows that U.S. stock prices are more expensive than European and Japanese ones, at least based on current earnings. They may have better expected growth, but based on current earnings, they're more expensive. After COVID, that really jumped. Some of the U.S. stocks prices took off, and the European and Japanese markets did not take off. So we had a huge gap post-COVID. That's starting to close a little bit after the sell-off last year, particularly in U.S. tech stocks. But there's still a pretty meaningful gap. Some of that is warranted. We do have some really good companies listed on our stock market, some good technology companies that are capable of growing earnings faster than a lot of companies in Europe and Japan. So, I think a little bit of a premium is warranted. I don't think a very large premium is warranted because I don't think the economic growth conditions of the U.S. are superior to the European Union and possibly even Japan these days. So you get a nice discount if you're willing to invest in Europe and Japan. Switching gears to emerging markets, China. You need to talk about China if you're going to talk about the global economic environment. What this is showing you is, in that blue part of the bar chart here, reflects China. This is Goldman Sachs' forecast of global growth and the countries that are going to contribute to it. This is on a quarterly basis. So you see in Q2 of 2023, Goldman projects there's going to be a surge in global growth. Almost all of that is going to come from China. Their expectation is, as China opens up from the COVID lockdowns that have lasted far longer than any other economy, there's a lot of pent-up demand, and that money is going to be spent, and there's going to be a surge in economic growth in Q2, leading into Q3, and sort of flattening out as you get into the end of the year and into 2024. It remains to be seen. That's very hard to predict. There's certainly savings that can be spent. Use is almost like an exercise in forecasting psychology. People do have savings they can spend, and are they going to spend those savings just because they have a little bit more freedom to do so? Probably to a certain extent, but the property market, which I'm going to talk about next, is definitely a concern. So just lastly, talking about that, if China pent-up demand does really pick up in a meaningful way starting in Q2, that could also, excuse me, slow down the deceleration in global inflation that we've been seeing, because they're a huge consumer of materials and lots of other goods, and growth in China could perhaps slow down some of those inflation dynamics that we're looking at. Next slide here. This is another slide on China. On the right, it's showing you monthly new house sales, and the year-over-year trend is still negative there. If you looked at property under construction, negative year-over-year trends, home prices, negative year-over-year. So the China property market is not healed. If you recall in the news, China Evergrande and some other property developers have gotten in a lot of trouble with just the structure, the way they finance property development in the Chinese market. Bond prices of a lot of Chinese developers have rebounded, but they haven't rebounded to where they're safe, in a safe territory. There's still very high yields to be had investing in bonds of Chinese property developers, which means people think the market is still, there's some tenseness there, and all is not healed in the Chinese property market. Property is really big in China. A lot of high percentage of individuals' wealth is derived from the property ownership in China, more so than in other nations. When there's unease about the property market, it could lead to consumers pulling back on expenses and other items. So that could impact consumer spending. But on the flip side, it directly impacts fixed asset investment. The orange line on the graph on the left shows, China's investment share of the economy. The other nations represented by the various colors, they are more consumer-driven economies. Consumption drives a lot of the economic growth. Investment, when you think investment, you think real estate, but you also think infrastructure, technology, equipment, encompasses a lot of different things. China grows their economy in that investment category. It's always been much bigger than the rest of the world. But if that investment category starts slowing, will consumers pick up the baton, and will they spend more to help stabilize growth? Because real estate is a big component of that investment category. So if real estate continues to be weak, then you got to look for other areas to drive the economy. Consumption is the obvious one, but it's pretty messy to transition from a fixed asset investment economy to a consumer-driven one. That doesn't necessarily go smooth, and I think what we're seeing signs of that is really the property issues in China right now. So that's one very good example of it. So there are definite strains in the Chinese economy that are not solved at this point. India, demographics in India are phenomenal. This is the growth rate they've had over the past couple of decades. They got hit pretty hard in COVID. So that one sort of yellow bar you see, I mean, India had it bad in COVID. They really took some hits. But they have rebounded, and they're still at this steady sort of high single-digit growth rate, which is really impressive. I mean, they're getting to be a pretty large economy, but they continue to have a steady high growth rate even as a larger economy, and the future looks pretty good for India. They have a lot of positive developments there. So looking forward, what is sort of the way to invest? Well, if you're invested in either of my two strategies, our international weighting is about the highest it's ever been. Why is that? Well, it really boils down to this. We don't think the premium U.S. stocks have to international ones is warranted. We think a modest premium of U.S. stocks to international ones makes sense, but the gap is too big. I have concerns with the U.S. economy. We need to see more productivity, and that very well could happen. But we continue to see the stubbornness in inflation. We don't have what I view as really healthy growth dynamics in place right now. On the flip side, Europe, I'm not saying Europe has a wonderful situation. The war is still very much a concern. But I think that they're not much different than the US. I already showed you that their labor force participation is actually moving into a better place than the US. So I don't think Europe is in such a bad spot right now that you would want to ignore allocating to them. And when you get the discount on stock prices, it makes sense to allocate. Same with Japan. I view them similarly. Then internationally, outside of the developed markets, China, India, I think an allocation makes sense. China, I think their economy definitely has some concerns ahead. I don't think all is clear. They may get some resurgent spending here in the near future from opening up from COVID, but structurally they have some challenges going forward. Nevertheless, the stock prices in China are down enough that an allocation makes sense. I could be wrong on this, but I've maintained that the communist government in China does not want to destroy capital markets, and they will allow companies to do things that would benefit investors versus the state. And so I don't have overwhelming concerns about state intervention in some of the Chinese companies that one would invest in. I do have concerns about their growth going forward, but there's enough of a discount so that it makes sense to allocate. And a lot of those other economies, India, that you don't get that discount, but they get really strong growth. Latin America looks okay, so there's a case to be made for allocating to yen. We'll leave it at that.